Dear student, let's start a practice video. In today's practice video, we'll be discussing a question on business valuation. In the previous live revision class, we did discuss all the concepts of business valuation. And in today's class, we'll be discussing question on business valuation. Let's see the requirements. That's a section B question, OTQ, 10 marks. Based on asset values, what is the minimum amount Frida should accept for equity of Minnow company? Based on asset values, minimum amount, floor value. Okay, and calculate market value of Minnow company using earnings. Give your answer to the nearest dollars. Calculate market value equity of Minnow using discounted cash flows. Let's read the scenario. Pike Company, a listed conglomerate, simply a diversified company which is doing number of businesses, is looking to buy Minnow Company. Pike wants to buy Minnow, an advertising company. That's very important. What Minnow is doing, advertising company. It means a service-based organization. If it's a service-based organization, then obviously they will not be having such high tangible value assets. Normally, their value of the business is within their services, the intangible element of the business. Advertising company, they are providing services. So if you ask me, valuing a company which is providing services, normally asset-based valuation, net asset-based valuation will not suit them. Why? Because they will not be having high tangible value assets. They are just a service organization. Advertising company owned and run by a Frida Minnow. Now, this is another important point. In a service-based organization, most of the time what happens, the loyalty of the customer is with those people they are running that small company rather than the product. Because when it comes to a large organization, those they are selling goods, the loyalty of the customer is with the goods. But when it comes to the service-based organization, then it can be seen most of the time customers they have the loyalty towards the person who's actually providing them the services rather than the company. Freda has agreed to sell and has insisted on a cash consideration as she wishes to retire. Now, this is a bit dangerous. Freda is running this Minnow company if she retires after selling the company. Again, it becomes difficult to get this same benefit which buyer wants to get from this Minnow company. Why we are saying? We are saying on the basis because the company is a service-based organization, and most of the time in service-based organization, customers they have a loyalty towards those people that are providing services. Pi company is considering issuing bonds to generate cash required. How Pi company is going to basically make the payment? Pi company is going to issue the bonds to raise the cash required. The following information is available. The statement of financial position for Minnow company. Net book value of equity is 10.3 million. Net realizable value is 11.2. I think we did discuss in the previous class also. If you ask me what is the minimum value, so basically the minimum value is the net realizable value. Nobody will be selling the business less than the net realizable value, which is 11.2 million. So this should be the minimum value. Minimum value of the business. Let's see. Do we have an option? Yes or no? Part A. So the minimum value is 11.2 net realizable value. The second is calculate market value now using earnings. Let's see. Statement of profit and loss. Minnow company made a profit after tax 7 million, but not current year, last year, previous year. This is expected to grow 3% next year. It means in the next year, the profit will not be 7 million. It will be increased by 3%. Despite owning and running the company, Frida Minnow does not take a salary, preferring to take money out of the business via high dividends. So Frida is not getting a salary. Frida is getting a dividend. We know that dividend payment does not save tax because dividend is already after tax. Pi company estimates it will need to offer a salary of 1 lakh to replace Frida when she leaves. Now, this is something very important. We know that it is mentioned in the question as well as Pi company is going to buy Minnow company. Frida gets retired. Okay, she will leave the company. So she will leave the company. Then obviously the need Pi company will have to hire someone. They are estimating they have to pay $100,000 as salary to that person. So obviously, number one, they have to bear the salary expense. Second, this salary expense will result in tax saving as well. Dividend payment does not result in tax saving, but salary expense does result in tax saving. Okay. Now look at this other information. Trout Company, a quoted advertising company with similar gearing and growth prospects to Minnow, has a P ratio 7 times. So basically, this 7 time is going to work. Examiner has given us a P ratio. It is mentioned in the second requirement that we need to value the business on the basis of earnings. But I did discuss in the previous class, when it comes to P ratio, you will be using a suitable P ratio. Over here, examiner has given us a suitable P ratio into sustainable earnings. So basically, if you look at this, 7 million profit after tax, that is of last year. Okay. In the coming year and the next year, it will increase by 3%. Another thing is, after Pike has acquired the Minnow, Frida will leave the company and Pike will hire a person replacing Frida. Pike will have to pay $100,000 as salary, and that will result in tax saving as well. So simply let us first calculate adjusted profit. Last year, I'm ignoring 3 zeros for the sake of simplicity. Last year, PAT is 7,000. It will increase by 3%. Okay. Now, Frida was not getting a salary, but new person will get a salary of 1 lakh. And due to that salary, there will be a tax saving also. Salary, 1 lakh. Tax savings on salary. So 100,000 to 30%. So here comes your sustainable earnings. Sustainable earnings, 7140. P ratio, they have given us a suitable P ratio, 7 type. I'm getting 49980. So it means or you can say 50,000. If you go into millions, so it will be 50 million because we have already ignored the 3 zeros. So the value of the business is going to be approximately 50 million. Let's see. Calculate the market value now using earning. Give your answer to the nearest million. Then it is 50. So it's answer of the business value is 50 million. Okay. Calculate the market value equity of Mina. Equity, okay? Using discounted cash flows. I did discuss in the previous class how to calculate a business value on the basis of cash flows. Let's see. Pie company anticipate that after making a number of changes, Minnow company will generate free cash flows 6 million next year. This is very important. Directly, examiner has given us the free cash flow for the next year. When examiner has given us the free cash flow for the next year, it means the next year growth impact is already included into the 6 million. Repeat. If you read it, the question says, Minnow company will generate a free cash flow of 6 million next year. So due to this next year information, it's a very normal assumption this 6 million includes the impact of growth as well. This is expected to grow by 4% per year thereafter. Now, how do we value? I did discuss if examiner has given you the cost of capital. So let me show you the business value. On the basis of free cash flows, business value is equal to free cash flows 1 plus growth rate, WACC minus growth rate. Now, please try to understand if free cash flow, you have the current year free cash flows, then it will increase with the 1 plus growth rate. Logically, free cash flow into 1 plus growth rate gives you results in next year. You can say expected cash flow. If you recall the concept of dividend valuation model where we did discuss that D naught 1 plus G gives us D1 and D1 is the next year. Expected dividend. Now here we are using free cash flows. It means FCF into 1 plus G gives us next year expected free cash flows. Examiner has already given you the next year expected free cash flows. That is why business value is equal to 6 million. Cost of capital, they have given us how much? The percentage of cost of capital is 12%. Okay. Growth rate is 4%. Whenever examiner gives you cost of capital, I'll be using the cost of capital. If examiner does not give you a cost of capital, then you'll go for KE. So let me use the calculator. Let's see how much we are getting. In the denominator, you will get 0.08. We are getting 75 million. We have already discussed one, I would say, concept in the previous class. What was that? When we are using basically WACC to calculate business value. So whatever the business value comes, that actually represents market value equity plus market value of debt. An examiner is specifically asked to calculate market value equity. This business value is actually VE plus VD, which is 75 million. Now let's see. Just deduct the market value debt, you will get market value equity. Bank loan. If you recall the discussion relating to the bank loan, we did discuss many times. In case of bank loan, we always assume the book value and market value of the bank loan is same. So simply we'll deduct 2.5 million as the market value of bank loan, because bank loan is an instrument which is not traded at a stock exchange. That is why we assume book value and market value of bank loan is same. Less market value of debt, which is the book value of bank loan, 2.5 million. So logically, the market value of equity is 72.5 million. Market value equity is 72.5 million. So whenever examiner gives you the cost of capital, you will be using that cost of capital for free cash flows to value the business. Okay, now so which one is the choice? Alpha. Which two of the following statements about the proposed acquisition are true? Which two of the following statements about the proposed acquisition are true? Freda probably prefers to take dividends due to tax considerations. Now, please read it. Which two of the following statements about the proposed acquisition are true? Freda probably prefers to take dividends due to tax consideration. Why they are writing, why Freda prefers to take dividend? Because tax rate on dividend is less as compared to, let's say, tax on salary, tax on employment income. So why Frida was getting dividend rather than the salary? The logic behind it makes sense, because the tax rate on dividend income is low as compared to the tax rate on employment income. A major risk faced by pie company is that customer will loyal to Frida rather than the company, so she may leave when she, yeah, this is perfectly all right. As we discussed, in a service-based organization, most of the time, uh, the risk is customers, they are not loyal with the company, they are loyal with the person who is providing the services. If the stock market that Pike is listed on is listed on its strong form efficient, then share price of Pike company will only react to the acquisition when the confirmation is published. That is incorrect. Why? Actually, if the stock exchange is strongly efficient, then share price will have the impact of this acquisition even before the announcement. There's no need of announcement. So basically, what they have written, it does not represent the strong form efficiency. In a strong form efficiency, there's no need to publicize something. Share price will already have the impact of everything. The directors of Pike should only be concerned about the unsystematic risk of Minao company. Again, I would say incorrect. Why? Actually, unsystematic risk is a diversifiable risk. And examiner is saying the director of Pike company should only be concerned about the unsystematic risk of Minao company. Actually, it is mentioned in the question. Pie company, a listed conglomerate. Now try to understand. Since Pie company is a listed conglomerate, means diversified business, so it is a normal assumption that your shareholders are well diversified. And when shareholders are well diversified, so basically they're not facing unsystematic risk. They are left with only systematic risk. So basically, the directors of pie company should only be concerned about they should not be concerned about the unsystematic risk. they should be concerned about this only systematic risk which you have to face. Because you are a conglomerate, a listed conglomerate, diversified business, your shareholder, it is assumed that your shareholders are well diversified, so they are not facing unsystematic risk. They are, let's say, already having a well diversified portfolio of investment. Due to that, they are not facing unsystematic risk. So logically, which two of the following statement about the proposed acquisition are true? That is A and B. Obviously, still you have any confusion, you can always ask in your relevant WhatsApp groups. Which of the following statements concerning the use of different valuation methods for Minnow is true? Which of the following statements concerning the use of different valuation methods for Minnow company is true? Let's see. Asset valuation are unlikely to give a good indicator of market value. That is true. There's a reason. Minnow company is an advertising company, a service-based organization, and normally they will not be having high value tangible assets. So that is why asset valuation are unlikely to give a good indicator of the market value for Minnow. So that is why we are saying it is true. Theoretically, discounted cash flow approaches are the best. 100% true. Actually, the most, I would say, superior investment appraisal technique is a technique when we value a business on the basis of free cash flows. So generally, discounted free cash flows technique is the superior as compared to other investment appraisal techniques. Dividend valuation model using historic dividend information would give a fair market value for the company. Now you can see that. You are saying that dividend valuation model using historic dividend information would give a fair market value for the company. Basically, by using dividend valuation model, you will not be able to get a fair value of the company. The question is why we are not going to get a fair value of the company by using dividend valuation model, because when we are using historic dividend information, there's no guarantee that the same growth rate will continue in the future. There's no guarantee that same growth rate will continue in the future. Another thing is, logically, dividend valuation model is suitable when one company wants to acquire in another company, let's say holding, which does not give them the control. So logically, dividend valuation model is a good technique to value a business if you want to get, let's say, less than 50% holding. Let's say if you want to get a 15%, 20% holding in that company. If I want to get a 20%, 15% holding in a company, it means obviously 15 or 20% holding will not give me the control in that company. Investing 10%, 15%, or getting equity of 10 to 15%, let's say. Obviously, I will not be getting a control. Number two, it means I'm only interested in the dividend stream of that company. So when an investor is interested in the dividend stream of that company, then it is very much logical to use the dividend-based valuation. So dividend valuation model is really good for a, you can say, for a small shareholding. When a buyer wants to get a small shareholding, when the buyer is actually interested in dividend stream of the company. So that is also, the last one is the false. Okay, which of the following statement concerning the use of different valuation method of monogamy is true? 1 and 2. So I would say it's a really good OTQ. So you need to go through once again. Still, you have any confusion, any problem, you can always ask the question in your relevant WhatsApp group. Now, let me share one homework which I really want everyone to attempt. Students, I'm just discussing a few homework questions with you, but rest of the question I really want everyone to attempt before the next class. I want everyone to complete all the MCQs of Kaplan Kit. BPB questions we have already done in our pre-recorded lectures. Already we have done it. Now it's time to complete the Kaplan Kit also. Let's see. The questions, MCQs on business valuation, they start from 158. They end at 188. Okay. Let's say what Miss Myers has been left $30,000. Mrs. Myers has been left $30,000, which she plans to invest on the stock exchange in order to have a source of capital. Okay. Should she decide to start her own business in a few years' time? A friend of hers who works in the city of London has told her that London Stock Exchange shows strong firm market efficiency. Wow. It means the share price, they indicate each and everything, past insider information, and the information which has been made public. If this is the case, which of the following investment strategies should Mrs. Myers follow? So, which one she should follow? Study the company reports in the press and try to spot undervalued shares to invest. Actually, you cannot do this. If the stock exchange is strongly efficient, it means everybody will have the same information. Don't worry at all. So by reading the report, you won't be able to get anything which others they don't have. Invest in 2 or 3 blue chip companies and hold shares for a long as blue chip companies means they're really good companies. But actually, when you are just investing in 2 or 3 companies, it means you're not making your portfolio of investment diversified. So you should try to have a diversified portfolio of investment. Just investing in 2 or 3 companies is not advisable. Build up a good spread of shares in different industry sectors. Now, that is make sense. Simply, we are saying to have a well diversified portfolio of investment. Study the company reports in the press, try to spot strongly growing companies. Again, you won't be able, in a strongly efficient stock exchange, you will not be able to beat the market because everybody will have the same information. So logically, try to build a diversified portfolio of investment. So 158 answer is Charlie. What is the current market value of each loan note to 2 decimal places? So we just need to calculate market value of debt. Number one is, students, if you recall, when we calculate market value of debt has nothing to do with the tax. Simply, market value of debt is equal to, you will take cash flow, that is interest. Let me make it a formula for you. Annual interest till redemption into annuity factor plus redemption amount into discount factor. And we know that if given debentures are, let's say, convertible debentures, then in case of redemption, you have to check conversion value and redemption amount, whichever is higher. And if it is not a convertible bond, if it is a straight debt, then we'll simply take the redemption amount. So redemption amount into discount factor. A company has 7% loan note in issue, which are redeemable in 7 years' time at a 5% premium to their nominal value, which is 100 per loan. The before tax cost of debt is 9%, so this 9% will be my discount rate. Annual interest, 7% of 100 is 7. Multiply my annuity factor for the 7 years at 9%. Redemption amount is 105 into 1.09 minus 7. Annuity table will be given to you. Otherwise, if you want to use a formula of annuity factor, 1 minus 1.09, the power is minus 7 upon 0.09. Let's use the calculator. What are we getting? What are we getting? So 1 minus 1.09, the power is minus 7, divided by 0.09. Students, I'm getting 5.0329, so make it 5.033. So 7 multiplied by 5.033. 105 into 1.09 minus power 7. The entire value is going to be 92.67 for 2 decimal. Simply the market value of debt, and when we are calculating market value of debt, we do not take tax. We do take tax when we are calculating IRR for KD1 minus T. Here we are not calculating KD1 minus T. Here we are calculating market value of debt. Question 160. What is the current share price to 2 decimal places? TKQ company has just paid a dividend 21 cents. They paid a dividend 21 cents per share. Its share price 1 year ago was 3.1. Total shareholders return is 19.7%. Now look at this. Logically, total shareholders return is equal to capital gain plus dividend divided by opening share price into 100. Now let me make more clarity. When we say capital gain, so basically capital gain is simply the change in the share price which has come during there. So capital gain, you can say, is just a change in the share price plus dividend and opening share price. Now let's come to the question. What they're asking the current share price. What is the current share price? Okay. The return is 19.7%, so 0.197 is equal to change in the share price. I'm just taking X plus the dividend they have given us, 0.21 cents. Share price, opening share price examiner has given us 3.1. Okay. Let me use the calculator a little bit. 3.1 will be multiplied by 0.197. 0.197 into 3.1. If I multiply this and this, I'm getting 0.6107. X plus 0.21. So this 0.21 comes other side of is equal to, it becomes negative. Change in share price is equal to 0.610 minus 0.21. I'm getting 0.4007. That is change in share price. Now listen, logically change in share price that is equal to current share price minus the opening share price. Opening share price. Change is 0.4007. Current share price, I'm taking, let's say Y, I don't know. Opening share price, they have given us 3.1. So 3.1 will be added to the change in share price. So here comes your current share price. 3.1 plus 0.4007. It will be 3.5007. If we need to work for one decimal, then it will be 3.5. They're asking to go for two decimal. So I'll take 3.50. Two decimal, 3.50. Let's try one more question. Compton company has announced a 144 right issue at a subscription price 2.5. So subscription price is 2.5. You can get the right by paying 2.5. The current come right means before right is share price is 4.1. What is the new X right market value? Simply examiner is asking us to calculate the share price after the right issue. It's very simple. Shares, values, and total value. Student, if you recall, we used to make 3 columns. You will get, if you have 4 shares, you are getting 1 right. Share price before right is 4.1, right price is 2.5. So 4 multiplied by 4.1, I'm getting 16.4, and 1 multiplied by 2.5, I'm getting 2.5. So we can say that 5 shares, they have a total value of 18.9. So when 5 shares, they are having a total value of 18.9. We can very easily calculate share price of 1 share. 18.9 divided by 5. So I'm getting theoretical X right price. Theoretical X right price is 3.78. And a student, please let me tell you, these are the practice videos. That is why the speed is a little bit on a higher side because of the practice videos. And obviously, when you are watching this lecture, it means you have already done with the business valuation, and we have already covered the entire BPB kit. Now we are doing the Kaplan kit. Okay. So theoretical exit price is 3.78. Great. Let me just do one more question of the homework for you. But after that, I'll give you the homework. You have to do it, okay? An investor believes that they can make abnormal return by studying the past share price movement. In terms of capital market efficiency, to which of the following does investor believe? That is basically technical analysis. There are experts. What do? They basically, the technical analysis means investor, they study the past share price movement trends. They see the trends, charts. They try to predict the future prices. Obviously, it's not so easy. That's pure technical analysis. That on the studying the pattern of the past share prices movement, you are trying to predict the future price. Technical analysis. Let's discuss one more question, but student, after that, I want you to do the homework, please. Super company has 50 million shares in issue, and its capital structure has been unchanged for many years. So the number of shares which company has issued, they are 50 million. Its dividend payments in the year X1 till X5 were as follows. We have number of years. Whenever examiner gives us the information of the dividend for the number of years, then you have to calculate the annual dividend growth rate. Dividends are expected to grow at the same average rate in the future. Okay. According to the dividend valuation model, what should be the market price per share, P naught? At the start of X6, if the required return on the share is 25%, so this will work as K. Basically, examiner is asking us to calculate P naught. Logically, P naught is equal to D naught, 1 plus G upon K minus G. We need to calculate first the growth rate. Examiner has given us the information of how many years? Dividend information is given to us. If you just count, we have been given 5 years information. So just take the last year dividend divided by first year dividend. The data is 5 years, so power will be 1 upon 4 minus 1. Let me use the calculator. 4236 divided by 2200. Or whatever comes, the power will be 1 upon 4 means power will be 0.25. So the answer of the bracket is 1.1779 minus 1 into 100. So the growth percentage is simply, it is simply 17.79. You can make it 17.8%. or 17.79%. So growth is around 17.78%. Okay. If I calculate D naught, 4236 divided by 50 million means 50,000. This will give us the dividend per share. So the dividend per share is 0.08472. Now very easily we can calculate P naught. P naught is equal to D naught, which is 0.08472 into 1.1779. K is 0.25 minus 0.1779. So P naught is equal to, let's see what are we getting in the numerator. In the numerator, student, we are getting 0.099, make it 79. Okay. In the denominator, 0.25 minus 0.1779. I'm getting 0.0721. So let's see, 0.09979 divided by 0.0721. Students, I'm getting P naught 1.384. Let's see. According to the dividend valuation model, what should be the market price per share to the nearest 10 cents? If I go for the to the nearest 10 cents, 1.384 is equal to 1.4. So it will be 1.40, nearest 10 cents. Okay, students, I'm just discussing one more question of the homework, but please, after that, I would request everyone. Rest of the question, students, you have to attempt Obviously, if you have any question, any queries, you are more than welcome to ask question in your relevant WhatsApp groups. Okay, now let's see. The following data relates to an all equity finance company. All equity finance company. Logically, when we say all equity finance company, then logically the WACC of the business is equal to K. I'm just giving you the what do you mean by all equity finance company? Another interpretation of all equity finance company is simply that company does not have any loan, does not have any gearing because it's an all equity finance company. Fine. What is the market value of they are asking what is the market value of the company to the nearest $1,000,000. So examiner is asking us to calculate the market value of the company. Okay, fine. Let's see which formula we have to use. Examiner has given us the information of the dividend K. If this is the case, recall. We have discussed in the previous class, business value is equal to, just take the annual dividend into 1 plus growth, K minus growth. It will give you the directly business value. Okay, now. Dividend paid is 50 million. Fine. Earnings retained and invested is 70%. Now, this is very important. Their retention ratio is 70%. It means their payout ratio is 30%. Examiner has given us the retention ratio. Return on investment is 15%. Cost of equity is 25. So now you should be thinking for the Gordon growth model to calculate growth rate. Gordon growth model. G is equal to BRE. RE is the retention ratio, or B is the retention ratio. Here the retention ratio is 70%. RE. It is return on equity, return on investment. So B is the retention ratio, which is given to us 70%. 0.7. Return on investment, they have given us 15%. So logically, the annual dividend growth rate becomes 10.5%. Now, very easily, we can calculate business value is equal to annual dividend. They have given us 50 million into 1.105. K is 25% minus 0.105. Simply by using calculator, what are we getting? Just a minute. 50 multiplied by 1.105. In the numerator, I'm getting 55.25. Denominator 0.25 minus 0.105. I'm getting 0.1145. So 55.25 divided by 0.145. Student, I'm getting 381.03448. So make it 381 million. To the nearest $1,000,000, 381 million. So the business value is 381 million. So student, I really want everyone to attempt the homework. Okay, I'm just doing one more question. This is perfectly a last, I'm telling you, last question. But after that, obviously, you people have to do the homework. Let's just one more. It looks a good question to me. That's why I'm doing it. On the basis of these estimates, what is the maximum that the shareholder of beta company should pay for the entire share capital of alpha? Students, first you need to understand the requirement. On the basis of these estimates, what is the maximum that the shareholder of beta company should pay for the entire share capital of alpha company? So on the basis of these estimates, what is the maximum that shareholder beta is going to pay for the entire shareholding of alpha? So it means beta wants to acquire alpha. The following information relates to two companies, alpha and beta. Earning after tax P ratio, alpha, beta. Beta company management estimate if they were to acquire alpha, they could have saved 1 lakh after tax on an administration cost in running the new joint company. So if you recall this 1 lakh, there is a cost saving. We did discuss in a very first, I would say, business valuation lecture. When one company wants to acquire another company, the main reason is to get the synergistic benefits. There are three types of synergies: revenue-based synergy, cost-based synergy, and financial-based synergies. Here, they will be getting cost-based synergies. Cost-based synergies are achieved by eliminating the duplication of functions, and which is happening in this question. There will be a saving of 1 lakh after tax. Make sure when you are using P ratio formula to calculate the business value, you will take each and everything after tax, because in P ratio, we multiply P ratio with the PAT. That is why if I need to bring any adjustment, that has to be after tax. New joint company, additionally, the estimated P ratio of the new company would be 18 times. Great. Now we need to calculate how much maximum we will be paying to alpha, maximum. So how to calculate the maximum value? Let me tell you. First, calculate the combined company's value. Combined company's value, or whatever comes, less pre-acquisition value of the buyer company. Now you will get the maximum value for the seller company. Maximum value for the seller company. Now come here. Profit after tax, if I just ignore 30, alpha is 210, beta is 900. After they will become combined companies, after beta has acquired alpha, their earnings will increase by 1 lakh. And this 100,000 is after tax. Make sure. If 100,000 was before tax, we would have made it after tax. But 1 lakh is already after tax, so we'll take it as it is. So the combined earnings will be 210 plus 900 plus 100. Combined after tax earnings. Let me use the calculator. 210 plus 900 plus 100. There will be 1210. Group P ratio, which they have given us, 18 times. That will give us the combined company's value. Combined company's value. Let's see what is the combined company's value. That is 21,000. Now simply less pre-acquisition value of beta company, because beta is the acquirer. In pre-acquisition, beta earning is 900 and P ratio is 21. I'm getting 18,900. So the maximum value for alpha company is maximum value of alpha. 21,780 minus 18,900 gives us 2,880. This is the maximum value. It's a really good MCQ. That's why I did try with you. 2,880 means nearest is 2.9 million. Now, students, I would request, please, now you have to do the rest of the MCQs. From 166, they will go till, I believe, 188, if I'm not wrong. 188. Yes. So please, rest of the MCQs, you have to do it. In any MCQs, if you have any issue, you are more than welcome to ask in your relevant WhatsApp groups. Plus, I did mention earlier also the objective of these live revision classes. What are the objectives of conducting live revision classes? Which we conduct in every paper of a skill, every paper of professional level as well. Number one objective is to give you the revision of the entire syllabus in a very short period of time with different questions which we have not covered in our pre-recorded lectures, which you can see here. We have covered the BPB kit in our pre-recorded lectures. Now we are in live revision classes. We are covering the Kaplan kit. So one objective is to give you the entire course revision in a very short period of time. Second, with the new questions. Third, very important is if you want any topic, means any topic of FM to be revised in a great detail, plus you want us to discuss any question of FM, just mention in your relevant WhatsApp group. So I'm going to conduct the class on that topic. We will discuss that topic in a really good amount of detail. And any question and any number of questions you want us, we are ready to discuss with you in live revision classes. So these are the objectives of our live revision classes. Plus, we know that you know this WhatsApp groups are there for the enrolled students. And I personally reply to all the queries, no teacher assistant, because I strongly believe, since I am the one who has taught you everything in my pre-recorded lectures, I'm teaching you in the live revision classes as well. So I'm in a better position to answer your queries rather than anyone else. So students, thank you very much. But I would request, please do this homework. And if you find any question, any MCQs is disturbing you, you just tell us, we'll discuss. Thank you very much. So see you all inshallah in the